man, it's time to do another Q&A video.
Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com, doing another Q&A video, finding great questions on the internet to help answer just maybe questions you're thinking about. But if you have a specific question, comment, please put it in the comments below. I'll get to those in later videos, but let's just dive right in. Let's see how many questions we can answer tonight. All right, let's see. What happens if you don't tell your mortgage company you're renting your property? You don't have to tell the mortgage company what you're doing with your property. It's yours. It's a lien against the property. You don't have to tell them you're changing ownership, changing it from a second home to a primary residence. You have that loan in place based on the time you did the loan. So you don't have to tell a mortgage company that you're actually renting the home out. So that's the short answer. I have a lot of people think they need to do something with their loan. They have to call the lender. No, that loan's in place. It's against the property. That's the collateral of the property. You own the home. You're not renting it from the bank. You own it. You can do what you want with the property. Let's see. What are the benefits of getting a jumbo loan instead of just refinancing your current mortgage when rates go down? So a jumbo loan is whenever it's over the conforming loan limit. For the coming year, 2023, the loan limit is raising to $726,200. I think that just got announced a few days ago. It's going up to $726,000. So what are the benefits of getting a jumbo loan instead of just refinancing your current mortgage when rates go down? You're still going to be getting a jumbo loan, or you're not getting a jumbo loan. It doesn't really have anything to do with being able to refinance. If you refinance out of a jumbo loan, you have to put additional money down to be under the conforming loan limit, or wait till the limit goes up to where then you can refinance. But a jumbo loan is anything over the conforming limit. Now, some parts of the country have what's called high cost designation, where you are allowed to loan more and still be in that conforming realm. Also, if it's a duplex, triplex, or fourplex, those limits can also go higher and still within the conforming loan limits. And why that's important, there's more guidelines, more lenders, and typically interest rates on conforming loans are cheaper than on jumbo or portfolio loans. Now, over the last 6 months, we've actually seen jumbo rates better in some cases because they didn't go up quite as quick as the other loans, but that started to catch up a little bit. But in almost every market, the jumbo loan's a little bit more expensive. But you can't just do a jumbo loan, then refinance out of it without putting a bunch of money down to still be under the conforming loan limit. Let's see. How does having a home equity loan help pay off your mortgage faster? So it doesn't. A home equity line of credit is a second mortgage. It's more debt being added to it. I have seen some programs out there where people use a line of credit as a credit card where they put all their expenses on it, then pay lump sums to it, and then take that money and pay down the mortgage with it. So it's freeing up cash flow. So there are some options out there that tie home equity lines into these budget systems to help accelerate your mortgage. I think way back in the day, there was one called You First Financial. I don't know if it's still around anymore, but it had this option where you would use the line of credit, put all your expenses on that, then you take your whole paycheck and put it on it, and then you pay that towards a mortgage. And it kind of had this budgeting system, so to speak, to help you rapidly pay off your house. But the short answer is, how does a home equity line help pay off your mortgage faster? It doesn't, unless you're using the line of credit to pay off other debts that you can then take that money from the car loan, the Visa, whatever you're paying off, and put it back towards the mortgage. So that's the only way to do it. Otherwise, you're just adding debt. If you're getting a home equity line of credit, you're adding a balance or adding a loan to your mortgage, even though it's now two loans instead of one. So it doesn't automatically pay down your mortgage faster without freeing up money and putting more money towards your mortgage. Let's see. What is the option of paying off a home loan? What is the opinion of paying off a home loan? Is it considered a part of personal debts to be paid off? Why or why not? So here's my stance on paying off a mortgage. I think it's something it's a goal you want to reach, but it isn't the first thing I think you should pay off. One, the rates are probably better. Two, they're usually locked in. Three, an extra $100 on a mortgage doesn't go as far as $100 on a Visa, a car loan, or emergency funds or retirement. There's places that $100 can go that will reduce your debts faster than putting it towards a mortgage. Once all those things are paid off, then yes, take the amount you're paying towards the car, the Visa, whatever debts you're paying off, and move that down the chain. They call it the snowball effect, where you take those payments and move it to the next debt. So now you're adding $200 to the mortgage, now $300, now $400, now $500. You're rolling that down the hill to where now you're making significant payments. But keep in mind, it's great to pay off the debts, but I think you need to start with having an emergency fund first. You need to have $1,000 that's not in your day-to-day checking account, somewhere that is not part of your checkbook and your Visa, something that's a true savings account that has $1,000 in it to cover if the transmission of the car falls out, or you need new tires, or a medical issue pops up, or something pops up. You want that money to have access to that. That way you don't have to borrow for those emergencies. Step number one, get a savings account that has at least $1,000 in it. Then start looking at paying off debts. You want to start with the lowest balance first, not the highest interest rate. And the reason I say that is more money on the lower balance can go further than on the higher interest rates. And once you're able to pay off a few of the smaller ones, not only do you have some victory and some momentum growing because now you've got those debts gone, but now those minimum payments can be chunked together and put towards another debt. You'll really get that snowball really going down the hill once it starts to grow some momentum. And then build up a bigger emergency fund, then start paying off the house. I think those are the steps that are way smarter than trying to accelerate a mortgage if you still have other debts. Let's see. How does one become a mortgage broker in the United States? Oh boy, this is boring. All right. So to become a mortgage lender in the United States, you have to get registered and pass a test. You have to do a pre-licensing course to be able to then pass that test. Then you have to park your individual license with a mortgage company, another mortgage broker. If you want to be a mortgage broker by yourself, just like right off the bat, you usually have to have experience. You usually will have to have some sort of knowledge of the mortgage industry before you become a broker, or you're just going to have very limited options of what lenders you can refer to. But by teaming up with another broker, by teaming up with somebody that already has the licensing and already has relationships with lenders, you're going to be able to have better rates and terms. You'll be able to kind of pool other loan officers together and be able to become a mortgage broker. But to be licensed as a mortgage officer, that's kind of your first step, or be licensed. There's a pre-education course you have to take. Then you have to pass the required test. Then usually the state will also have some requirements to be licensed in the state. So there's federal requirements and state requirements. Every state's a little bit different on what they require. Then in Utah, once a year, you have to do a continuing education. It's 8 hours of continuing education for the federal requirements, and then another 2 hours for the state requirements. So it's 10 hours every year that you have to do, and then pay the renewal fees and renew every single year. It used to be every 2 years, and they changed it to every year. So to become a loan officer, there's pre-licensing education, pass the test, do the requirements within the state that you're in, then park your license with another mortgage company, whether it's a broker, a direct lender, a bank, whoever it is. That's where I would say start. Get some experience, start there, get some of the training that's available. You might not make as much on every deal until you build up some clients and until you start knowing what other programs are out there, but that's really the starting point. All right, let's see. What is the process for refinancing a mortgage? Can the lender ask for utility bills during this process? Boy, that's an interesting question. So what's the process of refinancing? Very similar to buying the house. They're going to check your income, your assets. You start with an application. That's really the pre-approval stage, whether it's a refinance or a purchase. You start with the application. Then the loan officer will be able to work with you to see what loan programs you qualify for, what interest rates you qualify for. With the refinance, there's different types. There's rate and term refinances, cash out refinances. Are you paying off a first and a second? Are you paying off car debts and visas? So you have to just sit down with your loan officer, sit down with somebody like me or call me. We review your application, find out what loan programs you qualify for, what your new payment's going to be. Can the lender ask for utility bills? The only time I ever see this really kick in is if we're trying to build credit, if it's a lack of credit, if there's not much showing up on the credit report. But needing utility bills is a pretty rare thing. I can't think of another reason we'd need it other than building credit, or maybe to prove occupancy in the home. But even then, I don't see that really kicking in because there's other types of things we can see, like the address on the pay stub or the W-2 should match where you're living. If all that stuff doesn't match and you say you're living in the home, maybe that's where they're trying to do is just prove occupancy. So there's always a why. I tell people this all the time. All this stuff that we have, all these guidelines, all these answers are all man-made. Home loans, guidelines, underwriting, process, insurance, appraisal, title, all this stuff is all man-made. There's always a why behind this stuff. So ask the why. Say, hey, why do you need that? They'll tell you. If they don't tell you, then something maybe a little more fishy is going on, or the loan officer just doesn't know. Have them talk to the underwriter. Have them talk to his manager. Have them talk to the the closing department. I mean, there is a reason why they need that. I'm just trying to brainstorm here. I think the only reasons is maybe prove occupancy or maybe something to help build up the credit file. Maybe there's just not enough on the credit file. All right, let's see what else we got here. When do new real estate listings in MLS get updated? That's a great question for a real estate agent. As far as I know, is whenever they go in and update it. So I think it's something where it's just information that's inputted by transaction coordinators and other real estate agents, and they can go in and update it whenever. On Zillow, I see sometimes it takes a lot longer to update on their system, but that's not really technically a multiple listing service. I guess it kind of is. It's a privately owned one instead of having one that's maybe for the county or specifically for the state or region where it's at. But when it's updated is when they go in and update the listing. What is the difference between a forward and a reverse mortgage? The simplest definition is a forward mortgage is when you pay your payment, your balance goes down. A reverse mortgage, no payments are made, so the balance goes up. One pays down, one gets added. Reverse, forward. That's really the difference. As far as who can qualify for a reverse mortgage, that's completely different. You have to be a certain age to be able to qualify, which is really a retirement type program to help people get access to their equity. But usually it's very low loan to value. They're not going to loan very much on a reverse mortgage, where a forward mortgage, they're going to offer a lot more. But you can use a forward or reverse mortgage to buy or refinance or cash out. There doesn't really change a lot of those things. People think there's a big difference between how you can use the loan. Really, it just comes down to qualifying and how much they're going to lend, and the fact that your balance goes up instead of goes down. Payments are required on a forward mortgage. They're not required on a reverse mortgage. How are we doing on time? Okay, doing okay. Let's see. Can you use your own money for a down payment on an investment home loan? Can you use your own money for a down payment? What other money would you use? Well, of course you can use your own money. Are you using somebody else's money? So yes, you can use your own money for a down payment on an investment property. So typically investment properties require at least 15% down. The rates at 20% aren't as good as 15% down, but you have to deal with the mortgage insurance with 15% down. And then the rates are better when you put 25% down. So there's kind of this weird better at 15, a little worse at 20, better at 25. They kind of either want the mortgage insurance or they want a little more money down for investment property. But it can come from any source that's verified as long as it's not a new loan or from the seller. You know, that down payment can come from any of your accounts saving up. It can come from equity from another property. It can come from a loan. You just have to add that loan to your debt ratio, make sure you service it. Also with investment properties, they want to see the money down, and they usually have what's called reserve requirements. They want to see you have some money behind the down payment in case the renter leaves or there's problems with the property. Investment properties get foreclosed on more than primary residences. Because think about it. If you've got your home that you're living in with your kids and your family, and you've got investment property and they don't make the payment and you lose your job, which payment are you going to start missing first? Probably the rental property. Which ones don't get maintained quite as well? Probably the rental property. So they do have a potential for more foreclosure. So they want a little more money down, and they usually want to see you have a little bit of money in the bank to cover when the property isn't rented or some problem happens with the renter or they leave and you can't get it re-rented or something like that. All right, see, we're doing 13 minutes. Let's keep going. Let's keep rock and rolling. How much does a mortgage cost per month? Is buying a home cheaper than renting? How much does a mortgage cost per month? It depends on the term, the rate, the amount you're borrowing, just like a car loan, any other loan. That's a pretty broad question. Is it's based on the loan that you're getting. Now, it's cheaper because you're amortizing it typically over 30 years than if you're amortizing it over a shorter period of time. But a mortgage cost is based on the loan amount, the interest rate, and the term, just like any other loan. Is buying a home cheaper than renting? Depends on the market. In our market here in Southern Utah, generally no. Now, rents have been going up like crazy because home prices have also been going up. But generally speaking, rents are still below because they're always a little behind the curve. Because somebody has owned the home for years and years, they only owe maybe $200,000 or $300,000, even if the home's worth $500,000 or $600,000. So they can rent it for cheaper and still cash flow. So in our area, we've seen these kind of big spikes in home values that have had rents kind of are behind that curve, but they're catching up. across the country, I think rents are up like crazy because home prices have gone up so much, rates have moved up a little bit, and the cost of just doing everything is raised. So rents have started to move up as well. But I can just speak for our area and a lot of different areas that know in our area, buying the home is more expensive typically than renting that same home. Now, can buying a home be cheaper than rent? Yes. I mean, there's rent out there that's $10,000 a month. Well, mortgage isn't going to be that much, but for the same home, like for like, usually owning the home is going to be more expensive. But there's a bigger benefit. Rent is 110% interest. Not only are you paying all that money every month and not getting any appreciation of it, but you're not getting tax benefits. You're not getting the appreciation on the home. And I often tell people when you're renting, you do have a mortgage, just somebody else's. So it is more expensive, but it's worth it. There's other benefits to owning it, not just financial. I mean, we always talk about financial tax benefits and appreciation and blah, 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 but there's a pride in owning a home. There's a sense that it's yours. There's a sense that you can do whatever you want. You can have pets. I can't believe how many people just can't even own an animal or a pet or cat or dog because they can't because they're renting, where you can have that joy of having an animal of your own. You can paint a wall. You can put a picture on the wall. You can change things out. You can add on to it. You wouldn't do that with a rental. It just feels like it's a waste of money to put any money into it. But when you own it, there's a sense of, hey, I want to put nicer things in it. I want to decorate this home to my standard or my little customizations and stuff like that. Plus, usually the furniture and the stuff you're buying is kind of fitting that home. It's more long term than just some sort of rental property. So there's so many reasons to buy a home. I love being in this industry. I love people buying homes. I love helping them with this process, whether they're a first-time home buyer, investors, or move-up borrowers that are just moving in or downgrading into a smaller home. It's just such a fun process to help people with this whole mortgage and real estate thing. So, but it's not just financial. Financial is a big part of it, sure, because I mean, you look at a mortgage payment's way more consistent. Like when you look at renting, it always is changing. It's always going up. But a mortgage is one of the more consistent payments you'll ever have for housing expense. Sure, the tax and insurance might change a little bit, but it's so much smaller than rents moving up every 6 months or 12 months, especially like we've seen over the last 2 years. So it's just a lot of reasons. Financial is definitely a big part of it, but there's other reasons to buy a home. All right, let's go a couple more here. We're about, 17, 18 minutes or so. Let's see what else we got here. Let's see. If you're still paying off your mortgage when you retire, can you afford retirement? Sure. Depends on how much assets you have and other debts that you have. I think it gets to a certain stage, again, where paying off the mortgage may not make the most sense. Because how do you get to the equity of your home? By selling or refinancing. If you're retired, you may not be able to get loans as easily as you can when you're still working. So you may not have access to the money unless you do a reverse mortgage that's a lot more expensive and the balance goes up every single month. So I think there gets to a certain point where paying off the mortgage, it's not necessarily too late, but is that the best use of the money? Is paying all this extra money, like taking the next 5 years, taking every dime you have and have the house paid off, and then have no mortgage payment, or get your mortgage payment as low as possible, get it as comfortable as possible with your budget, take the money you're putting extra and emergency funds or paying off all those other debts or having that money to actually live on instead of having all this equity. Equity is great, but you can't get to it without selling or refinancing. Would you rather have $100,000 in the bank as you retire or $100,000 in equity? Depending on your other situation, depending on how much is already in the accounts, I'd rather have the cash. I really would rather have the cash as long as I can maintain that payment, as long as it's comfortable. I think cash flow is more important at a certain point, and having access to liquid funds can be way more security than a bunch of equity you can't get to. Now, I've had people say, well, I don't want my wife to have to work. I don't know what's going to happen to me. It's the same thing. If you have all this money that's in life insurance or all this money that's in there, you can use that to make the payment or subsidize the payment. Or you can take all that money and just plunk it on the house, and now they have no money in the bank, all this equity they can't get to because they can't refinance. They don't have any income or a job or something like that. It just gets harder to qualify for a loan. And then you're talking loan fees and loan costs and all this other stuff, where if you just would have had the money in the bank making the payment or helping to make the payment, that just might be a better financial plan. So I think it depends on your age, retirement, what else you've done to build up your retirement. But just saying you can't retire because you have a mortgage, it really depends. It really depends on the situation. But I've seen people that just will take the next 5 years and live as just tight as they possibly can to try to get that mortgage gone, $100,000, $200,000 mortgage. Then they only have 2 years to enjoy it. They pass away, or they they only have 2 years to enjoy not having to make $1,000 payment every month. But it's like, well, why not have 100 grand in the bank and still have the $1,000 payment? I think there's a balance. I really do. I think there's a balance between what makes the most sense at certain stages. Now, if you're younger, still working, and you can get those things in budget and get the mortgage paid off, do it. Do it if you can. But if you're 60 years old and you still owe $300,000 on your mortgage, and you're now not working and you're only living on Social Security, I don't think taking all your Social Security check and put it towards the mortgage to try to pay it off in the next 10 years, it might be too late. It may be just better places to put that money. Or maybe do a hybrid, pay a little extra in the mortgage, sure, but get the rest into some other account that's either earning some interest or just emergency, or just where you can get to it without having to sell or refinance the home. All right, let's do one more question, and we'll send you on your merry way. I hope you enjoy the videos. I really like doing these. I don't pre-screen these. I just find them on the internet. I go into like Quora and Facebook and Yahoo Answers and just see what questions are posted on here, and just answer them just to see where we're at. So this is just all just kind of unscripted. Let's see. Is it better to close a home loan before the EMI ends? Oh, that's an interesting one. Maybe. No, I don't know. All right, let's go to another section here. Let's see. Ooh, mortgage home loans. Let's do this one. All right, we're out of time. We needed to go quick one. Try to find a quick one here. First one on the top of this one: how do interest rates affect mortgages and home buying? The biggest thing that they affect is your buying power. So before, if your house payment can be $2,000 a month, maybe that got you a $400,000 loan. Maybe now it only gets you a $300,000 loan. So as interest rates go up, what you can afford with the same monthly payment goes down. The buying power just goes down. That's what we're all seeing with inflation. All the things, just the dollar isn't going as far. How many gallons of milk, just you can't buy as many. Or you go to the grocery store and it used to be like $400 for the basket full of stuff. Now it's $500 or $600 to take that same basket out of the store. So interest rates slow and slow things down a little bit, give supply chains a chance to catch up. It lessens how much money is in circulation, which is supposed to help with inflation. So higher interest rates, how they affect mortgages, the biggest thing is they lower your buying power. So the same amount of buyers, all of it's just been lowered by interest rates going down. I had a client that was pre-approved 6 months ago for a certain amount. Now we reran the numbers and he just doesn't approve. He just doesn't approve for that much. So he has to go find a cheaper house, or has to free up his budget to be able to afford the home that he really wants. So that's the biggest effect on interest rates, buying power. It's really buying power is the best answer for that one. All right, let's do one more. Let's see. How do you know if your home will appraise for the asking price? This is mostly a first-time home buyer, or not a first-time home buyer, but a home for sale by owner. So somebody that's a for sale by owner, that's probably a big question for them because they don't know if they're listing the house correctly. That's where we're talking with a real estate agent or talking with an appraiser. A lot of the appraisers don't work for lenders directly. You can call any appraiser. You can open up a phone book, even talk to a lender and get a recommendation for an appraiser. They can give you a basic idea of what your home is going to appraise for, or they even have these lesser fees, maybe $250, $300 to do more of a certified market analysis that they usually do as a desk review or desktop appraisal, where they don't come out to your home and spend the time and do that. They just look at square footage, look at comps, and give you a pretty comprehensive report on what your home is worth. But until you actually get it under contract, you won't order a full appraisal, or the borrower won't order an appraisal until then. So how do you know? You just do some market research beforehand and make sure your house is priced out correctly. But talk to an appraiser. There's no reason in the world you can't call an appraiser and just say, hey, I'm thinking about selling this house. What would you charge to just do a comp search or a market analysis? If you talk to a real estate agent, they're going to try to get the listing. So if you're not wanting to go down that road, maybe talk to an appraiser, but talk to a real estate agent too. They're going to give you a great idea and maybe look at listing the property. I'm a big fan of real estate agents if you use the right ones. Unfortunately, there's a lot that are part-time. There's a lot that don't do it day in and day out. They only sell a couple properties a year, but there's great real estate agents. There's some amazing real estate agents out there that you should list your house, because I think the consensus is, and maybe play this out in your mind as well. If you see a house for sale by owner, kind of your first thought is, well, I can offer less because, one, the asking price, who knows what it really is, or if it's really worth that, and they're not using a real estate agent, so I can take some commission off the top, so to speak. So it's funny how often I hear borrowers come into my office that say that same thing. Well, they're asking $400, but they're not using an agent, so I'm going to offer them 350, or 360 or 370, less because they're not using an agent. So it's funny how often people pay for a real estate agent by price reductions or all the other things that you use an agent for, and they're not getting the benefit of having an agent. So if you're leery about using real estate agents, you're just using the wrong ones. They're well worth it if you find the right real estate agent. Call me. I'll tell you which ones are the great ones. Call a title company. They'll tell you the great agents. Check their numbers, check and see how many closings they've done, check their personalities. I mean, there's some great real estate agents out there, and I recommend them every time. Buying or selling, use a real estate agent. They're worth the commission if you use the right agent. All right, get off the soapbox for a second. See how we're doing on time. Looks like we're out of time today, folks. I don't have a name for this show other than just Mortgage Nerd and Q&A. I got to get better at like the search engine optimizations and I'm learning a lot by doing these videos. I tell you what, so much goes into putting these videos and editing them and all kinds of fun stuff. But hope you enjoy the show. I'd love you to be a part of the channel. Ask questions, comments, concerns. If you need help with a home loan, my website's right below here, ryanbolton.com. I do lending in the state of Utah and Nevada. I'm based out of Southern Utah, St. George. Absolutely love it here. Moved here in 2005. I love St. George. It's great. So if you need any help with the area or have any questions, even if it's not in the States, I'd love to answer any questions you have. I really love what I do for a living and would love to help you own a home, whether you use me or not, whether you just need help on your loan. I'm here to help. So visit my website, give me a call, and can't wait to see you next time. Thanks.